Welcome back, everyone. Today, we're analyzing a story that isn't getting the headlines it deserves, how the latest economic and trade developments are creating serious challenges for the United States, while at the same time presenting unexpected opportunities for Canada. Here's the headline. U.S. consumer confidence has dropped to its lowest level in months. Cross-border Canadian tourism is declining sharply, and trade negotiations under the USMCA are entering a critical phase. On the surface, these events may seem unrelated, but when we look deeper, a clear pattern emerges. The U.S. is facing setbacks and Canada is quietly gaining an advantage. Let's start with consumer confidence. In 2025, following several tariff measures and policy decisions, U.S. households are showing growing concern about rising prices, supply chain disruptions, and economic uncertainty. Retailers are reporting slower sales, and spending on imported goods has dropped. For the U.S. This is a warning sign: slower growth, potential job market impacts, and weakened domestic demand. But here's the nuance. Canada is benefiting. Canadian exporters who historically rely on U.S. demand are now diversifying. They're seeking new markets in Europe, Asia, and Latin America. Some Canadian producers are even redirecting goods that previously went to the U.S. back to domestic markets. This shift is strengthening Canadian economic resilience and demonstrating a pattern we've seen before. When the U.S. tightens, Canada adapts and thrives. Then there's tourism. Millions of Canadians traditionally visit U.S. border states like Michigan, New York, and Washington each year, contributing billions in revenue to hotels, restaurants, and local businesses. But in 2025, political tensions, rising travel costs, and economic uncertainty have caused a significant drop in Canadian cross-border travel. For U.S. border states, this is a loss. For Canada, it's a gain. Canadians are spending more domestically, boosting local tourism and supporting provincial economies. Finally, the USMCA trade talks. The United States is pushing for broader access to Canadian markets in sectors like dairy, automotive, and digital services. Canada, however, is positioning strategically to protect key domestic industries. This careful approach not only stabilizes Canadian prices but also enhances Canada's bargaining power, a lesson history has shown time and again. Over the next few minutes, we're going to break down these developments, connect them to historical decisions and trends, and explore what this means for the future. By the end of this analysis, you'll understand why in 2025 and beyond, U.S. economic weaknesses are turning into Canadian strengths, and how history suggests these patterns may continue for years to come. Let's dive deeper into U.S. consumer confidence, a critical indicator that reflects not just spending habits but the overall economic mood. In 2025, American consumer confidence has fallen to its lowest level in months. Why does this matter? Consumer confidence drives retail spending, housing markets, and even manufacturing demand. When confidence drops, people spend less, delay major purchases, and businesses adjust production accordingly. Historically, we've seen similar patterns. For example, in 2018, after tariffs were imposed on steel, aluminum, and other goods, U.S. consumers began feeling the pinch. Higher prices and supply chain disruptions slowed spending. Yet during that same period, Canadian exporters redirected steel and aluminum to Europe and Asia, sustaining revenue streams while U.S. industries struggled. Fast forward to 2025, U.S. households face rising costs due to a combination of tariffs, inflation, and policy uncertainty. Retailers report weaker sales on imported goods, electronics, household items, even clothing. This slowdown affects small businesses, particularly in border states where Canadian shoppers traditionally supplement local spending. Now let's talk about how Canada benefits. With U.S. demand for Canadian exports softening temporarily, Canadian companies have been forced to adapt quickly. Many are diversifying into global markets, securing trade agreements with Europe, Latin America, and Asia. Others are focusing on domestic consumption, producing goods that Canadians increasingly buy instead of relying on U.S. buyers. There's also a psychological and strategic component. When Americans tighten their spending, Canadian businesses and policymakers gain leverage in trade negotiations. Canada can resist pressure to lower tariffs or give up market protections because they are less dependent on U.S. demand than before. In other words, A weaker U.S. consumer base strengthens Canada's negotiating position. Historically, a lesson learned during the 2018 to 2019 steel and aluminum tariffs, when Canada maintained protections while U.S. producers faced global competition. Another dimension is currency movement. When U.S. economic confidence dips, the U.S. dollar can weaken relative to the Canadian dollar in targeted periods, making Canadian exports more competitive abroad. This means Canadian manufacturers and exporters can secure better deals internationally, even while U.S. companies struggle to maintain market share. So the takeaway here is multi-layered. U.S. consumer weakness is clearly negative for Americans. Slower growth, lower spending, and potential employment pressures. But for Canada, it creates a window of opportunity. Diversify exports, strengthen domestic markets, gain trade leverage, and maintain economic resilience. History shows that when the U.S. slows, Canadian markets often adapt faster and more efficiently, turning challenges into long-term advantages. Now let's shift our focus to tourism, a sector that reveals some fascinating dynamics between the U.S. and Canada. Traditionally, millions of Canadians cross the border annually to visit U.S. states like Michigan, New York, Washington, and Minnesota. In 2019 alone, Canadians spent over $22 billion in the U.S., supporting hotels, restaurants, retail stores, and entertainment venues. However, in 2025, we are witnessing a significant decline in cross-border travel. Why? A combination of political tensions, rising travel costs, and economic uncertainty in the U.S. is discouraging Canadian tourists. Currency fluctuations also play a role. When the U.S. dollar strengthens, Canadian travel becomes more expensive, leading more people to stay home. From the U.S. perspective, this is negative. Local economies in border states are losing billions in tourism revenue. Hotels, restaurants, shopping centers, and even gas stations are reporting slower business. Small business owners who heavily rely on Canadian visitors during peak seasons are particularly affected. This is not just a minor slowdown, it reflects a structural shift in cross-border spending patterns. But here's the Canadian advantage. With fewer Canadians traveling to the U.S., domestic tourism experiences a surge. Provinces like Ontario, British Columbia, and Quebec are seeing increased hotel bookings, higher restaurant traffic, and more spending on local attractions. Money that once flowed south is now circulating within Canada's economy, strengthening local businesses and provincial GDP. Historically, we've seen similar patterns. During the 2008 financial crisis, U.S. economic weakness led to a temporary decline in Canadian spending abroad. Canadians responded by increasing domestic travel, which helped sustain local economies when other sectors were under pressure. This pattern is repeating in 2025, but on an even larger scale because travel costs and political factors are compounding the slowdown in U.S.-bound tourism. There's also a strategic implication. Canadian provinces are now recognizing the value of domestic tourism and investing in infrastructure, marketing, and attractions. Over time, this reduces dependency on cross-border visitors and strengthens the resilience of local economies. In other words, a decline in U.S. tourism is not just a short-term gain, it's potentially a long-term structural benefit for Canada. Looking forward, I predict that Canadian domestic tourism will continue to grow steadily over the next 2 to 3 years, particularly in regions that traditionally relied on U.S. visitors. Businesses that adapt to this trend, offering localized experiences, higher quality services, and better marketing to domestic consumers, will be the big winners. So what we see here is a clear pattern. U.S. weakness creates Canadian opportunity. Reduced consumer spending, fewer cross-border travelers, and political tensions may harm U.S. businesses, but they simultaneously fuel Canadian economic resilience and growth in key sectors. Now let's turn our attention to trade negotiations, specifically the United States-Mexico-Canada Agreement, or USMCA. Trade agreements have always been a double-edged sword. They open opportunities, but they also expose weaknesses, and 2025 is a perfect example. Historically, the U.S. has used trade agreements to protect its domestic industries and expand market access for American businesses. Think back to the 2017 NAFTA renegotiations, which led to USMCA. The U.S. pushed aggressively for more access to Canadian markets in dairy, lumber, and automotive sectors. At the time, Canada managed to defend core industries while also accepting strategic concessions, a delicate balancing act that required foresight and negotiation skill. Fast forward to today, Canada recently appointed a new ambassador to the United States, strategically timed ahead of the USMCA 2026 review talks. The goal is clear: protect domestic markets while navigating U.S. pressure for greater access. The U.S., facing its own economic challenges, falling consumer confidence, sector-specific weaknesses, and political distractions, may not be in the strongest position to push its agenda. This dynamic creates an opportunity for Canada. Historical precedent shows that when the U.S. is internally pressured, Canadian negotiators can leverage that to secure better trade protections and concessions. For example, during the 2008 financial crisis, U.S. industries were under significant stress. Canada managed to maintain favorable export conditions and even redirected goods to alternative markets while the U.S. was focused on domestic recovery. Looking at 2025, the stakes are high. The U.S. wants greater access in automotive, dairy, and digital services. Canada, however, can defend domestic prices, maintain tariffs where necessary, and selectively grant access to sectors where it sees a strategic advantage. This could lead to a situation where U.S. exporters gain some short-term access, but Canada secures long-term market stability and strengthened trade leverage. Another key point is that trade diversification is accelerating. While Canada negotiates with the U.S., it is simultaneously expanding agreements and export channels with Europe, Asia, and Latin America. This reduces reliance on U.S. demand and strengthens Canadian resilience. Historical lessons confirm that countries that diversify their trade partners during periods of U.S. economic weakness often emerge stronger. Predictions for the near future are clear. Canada is likely to secure concessions in sectors like digital services and intellectual property, while defending its traditional industries. U.S. economic pressures, slower consumer spending, internal political challenges, and regional economic weaknesses are giving Canada a unique window to turn these negotiations into a strategic advantage. So, in short, the USMCA talks are not just about trade rules, they're about timing, leverage, and strategy. Canada is capitalizing on U.S. internal weaknesses to strengthen its position, diversify exports, and protect domestic markets. Finally, let's analyze specific sectors in the United States where weakness is creating clear opportunities for Canada. Understanding these patterns is crucial because they illustrate how strategic positioning, historical context, and market adaptation allow Canada to benefit even when its largest neighbor struggles. First, agriculture. U.S. farmers are under pressure in 2025 due to tariffs, declining exports, and rising production costs. Even with government aid packages like the $12 billion relief program, many farmers are struggling to offset losses. Historically, when agriculture faces such challenges, for instance during the 2018 trade disputes with China, Canadian producers were able to fill the global supply gaps, exporting more grains, pulses, and specialty products. In 2025, we are seeing a similar pattern. Canadian farmers are diversifying export markets, selling to Europe, Asia, and Latin America, while domestic supply chains strengthen. The result is that Canada gains international market share even as U.S. agriculture faces uncertainty. Next, manufacturing. U.S. automotive and machinery sectors are struggling with supply chain disruptions and rising costs. Canadian manufacturers, particularly in Ontario and Quebec, are stepping in to supply both domestic and international demand. Historical precedent reinforces this trend. During the 2018 to 2019 steel and aluminum tariffs, Canadian companies were able to redirect exports and secure contracts in markets that U.S. producers were losing access to. Currency and investment flows also play a role. U.S. economic uncertainty often impacts the U.S. dollar, creating periods where the Canadian dollar gains relative strength. This makes Canadian goods more competitive abroad and attracts foreign investment into Canadian markets. Companies that understand these patterns can leverage the timing for strategic growth, acquisitions, and expansion. Now let's tie everything together. Across consumer confidence, tourism, trade negotiations, agriculture, and manufacturing, a pattern emerges. When the U.S. experiences weakness, Canada adapts strategically. Canadians redirect spending domestically, diversify exports internationally, and leverage trade negotiations for protection and advantage. History shows that these adaptations are not temporary. They create long-term resilience and structural benefits for the Canadian economy. Predictions for the next 2 to 3 years. Domestic tourism in Canada will remain strong, particularly in border provinces, as Canadians continue to favor local travel. Canadian exporters will increasingly diversify into international markets, reducing dependency on U.S. demand. Trade negotiations under USMCA will likely result in Canada securing concessions in digital services and intellectual property, while protecting traditional sectors like dairy and lumber. Canadian agriculture and manufacturing will capture market share lost by U.S. competitors struggling with tariffs, production costs, and consumer demand. Overall, Canada will emerge more resilient with economic leverage, domestic stability, and international trade opportunities strengthened, while U.S. challenges continue to slow growth and create short-term market pressures. In conclusion, this is the story you rarely hear. U.S. economic struggles, whether in consumer confidence, tourism, or sector-specific weaknesses, are quietly creating advantages for Canada. History, data, and careful analysis all point to one truth: Canada is using these moments to secure long-term economic resilience and growth. So next time you hear about U.S. economic setbacks, don't just focus on the negatives. Look north, where Canada is quietly turning challenges into opportunity and shaping the future of North American trade and economics. Thank you for watching this deep dive. If you found this analysis insightful, make sure to subscribe, like, and hit the bell icon. Understanding these hidden economic dynamics is the key to seeing beyond the headlines, and we'll continue bringing you the analysis others won't cover.